The following is a production of the League of Southeastern Credit Unions and Affiliates.
I'm Bill Berg. I'm the Vice President of Compliance Training and Information for the League of Southeastern Credit Unions. I've been here for a very long time. I want to thank everybody for coming out this morning, taking time out of your very busy schedules to talk about risk-based capital. We have some interesting things that we're going to talk about. Well, interesting if you're I don't know how interesting it is, but anyway, the NCUA has a thing called the NCUA Express. How many of y'all have seen the NCUA Express or have signed up for it? Oh yes, we got Brick has signed up for it, Dee, you've signed up for it. I bet you've never seen it before. That's the NCUA Express. No, actually, this is what my take is on this proposal. It's a train wreck. It really is. It's so far off the rails, I just can't hardly believe that the NCUA came up with this particular proposal. And one of the things that I wanted to mention is don't take a look at your balance sheet today, because that's really things are getting better and have been getting better for several years. What you want to do is go take a look at what your balance sheet looked like in 2009, and then think about what is our balance sheet going to look like in 5 or 10 years. Because this proposal, if it goes through the way it's written, it has the potential to impact what kinds of blocks of business that you get into. So that can be a real issue for us. Also, it's interesting, the NCUA a couple years ago gave, let me ask this, survey, who's a low-income designated credit union? Okay, we've got Envision, we've got Tally Leon. So they allow you now to make unlimited amounts of business loans. The 12.25%, that's off the wayside. Now, on the one hand, the NCUA gave you that ability, and with this proposal, they're pulling it right back. So that's a potential impact for you, because it takes some effort to be able to do small business loans. You staff it up, and then, in fact, one of the reasons why credit unions don't get involved in it because of this artificial 12.25% of your net worth requirement. And so this is that's a change. One thing also, this proposal treats commercial loans twice as risky as credit card loans. Now, we know that business loans are risky, and we know that credit card loans are risky, but are the commercial loans twice as risky as a credit card loan? I don't think so. Also, this proposal does not differentiate between fixed rate mortgages and adjustable rate mortgages. So, and again, that really makes no sense. If you have an ARM that gets to adjust, you've shifted a little bit of your interest rate risk to the consumer member, which is, that's the whole point of an ARM. They shouldn't be the same. This proposal, without change, could cause credit unions to die a very slow death. And as credit unions leave the commercial loan market, I think that who's left there in the commercial loan market? It's going to be your banks. And the banks in 2008, one of the things that really affected our economy was they quit lending. I mean, that was the whole point of the TARP, was to inject capital into the banking industry so people would make loans. They pulled out. They're starting to get back into commercial lending, but boy, they pulled out for a couple years. So where did all this thing come about from? Well, there's an accord called the Basel III Accords. And what's interesting about Basel is it's like the third largest city in Switzerland. It's smaller than Tallahassee. And what I don't understand about that is, why would banking regulators around the world want to go to Switzerland versus Tallahassee? Okay, you got the point. Now, what's interesting, though, I kind of slipped through this slide. You have FDIC Vice Chairman Thomas Hoenig. He has actually been very negative about the Basel III Accords. He has been extremely negative about them, and he actually thinks that they should just start anew. Is that going to happen, Mary? No, not in, these are internationally agreed to voluntary standards. It's not going to happen. Now, when I was in Tampa, we had a couple of CEOs who said, we're going to advocate that they just do away with this entire proposal. I think that's an interesting letter that you could write, Bradley, but it's going to go into the stack where they really don't pay much attention to it. According to Thomas Hoenig, each new Basel standard attempts to correct errors and unintended consequences of earlier versions, but instead of resulting in better outcomes, each do-over has been more complicated and less effective. And then this final point on this slide is, if Basel III is good enough for the rest of the world, why in the world would the NCUA think that credit unions pose such a risk that we should have even more stricter requirements as far far as the risk weights than the rest of the world. It just doesn't make a lick of sense to me. During the Great Recession, natural person credit unions served as an important source of liquidity. The banks kind of bailed out. The Great Recession did not provide evidence for greater capital reserves for natural person credit unions, and the NCUA's across-the-board approach seems unnecessarily burdensome and raises concerns. And I've kind of talked a little bit about this slide, so I'm not going to really go into that, but I did want to mention about the bank leverage ratios. What was the event that was the precipitating failure in September of 2008? It was a large institution up in New York that failed, that was one of the leading things that caused the Great Recession. Anybody got an idea what that is? Bear Stearns. Bear Stearns was one of them, but you had another firm that went under, and their liquidity ratio was 43 to 1. Now, let me ask this, Mary. What's your liquidity ratio at your? What's your risk? What's your net worth ratio right now?
My net worth?
Yeah, ratio 10%.
We're 18.
Oh, 18. Okay, like almost double 10%. Okay, yeah. Okay. So this proposal is not going to impact you guys so much, but the thing, if you were at a 10% net worth ratio, you would have a 10 to 1 leverage ratio. But it turns out, some of these investment banks were 43 to 1, and they really just got slammed when they had no. And if you take that 43 to 1 leverage ratio and put it into net worth, that gives you a net worth ratio of maybe 3 or 4%. Jennifer, if your credit union had 3 or 4%, what would be the regulator's interaction with you? You probably wouldn't be there. Yeah, that's right. The credit union would probably not be there either. They really get mad when that happens. So, but it certainly didn't cause any problems for that. So, what's the definition of a small bank? I was asked in our Jacksonville workshop, what is a small bank? Because we have the small bank or the community bank Basel Accords, and I looked on the internet for a couple hours, and I saw all kinds of answers, 10 billion, this and that. So I wrote an email, and I got, according to Bill Hampel, he actually replied to this. And a note to self, whenever you send an email, you may be quoted. And that's exactly what I did. According to Bill Hampel, quote, I don't believe there's a firm cutoff for community banks, but one version is indeed 10 billion. If you looked at the rest of my email, I kind of was saying, well, this is one number I've seen, and here's some others. And then credit union folks might be thrown off by the term small bank Basel. It might be more accurate to call it smaller bank Basel. Some aspects of the more complicated rules kick in at different asset levels, some 250 billion. But the way that CUNA is taking a look at this is this applies to all credit unions. The small bank Basel requirements applies to credit unions. So the NCUA is seeking comments until May 28th. So you've got just over a month to make your comments known. And if you don't comment, the regulators will roll over us like a steamroller on this particular topic. It has the potential to be very ugly for us. It covers credit unions with assets over 50 million. So that, I think, covers everybody in this room. Not you. Well, how big? Oh, if I'm your regulator, Mary, yes. You are absolute. I'm going to say you got to be on this thing, because anything happens, boop, some people go out on the drop program, your assets are going to kick up over 50 million. So you're covered by this, even though you're not really yet. It also is going to restructure the NCUA's current PCA regulation to involve a calculation of a capital to risk assets ratio. It will require well-capitalized to maintain that 7% net worth, but also you have a risk-based 10.5% net worth. Now, some of the credit unions sit there and do the calculation, and they say, hey, because of our balance sheet composition, our risk weights actually went up. And that will happen. That will happen occasionally. But the thing is, there are several hundred credit unions that are going to be impacted significantly by this, and then there's a whole another group of credit unions that are very close to being impacted by this. This would change many of the effective risk weights for most of NCUA's current asset classifications, set higher risk weights and hence higher capital requirements if you have higher concentrations in real estate loans, business loans, long-term investments. It would also, and this one I find particularly obnoxious, it authorizes the agency to require even higher capital on a case-by-case basis. Now, I know that no one in this room has problems with their examiners, right? I never have had one, right? That's a joke. You're supposed to laugh when I give you a joke. Okay. But here's the thing. Sometimes your examiners come up with unreasonable things. And what's interesting is you're not able to appeal an examiner finding. So if your examiner wakes up on the wrong side of the bed, they have a fight with their significant other, their dog bites them on the way out that morning, they're irritated, you know, this is the 13th night they've spent away from their home. They could potentially, create some troubles for you, and we just don't feel like, if you're going to go with this standard, you don't need to have this extra license. And in fact, one of the things, I use this when I talk about regulators, they have a quiver full of arrows. And if they want you to do something, if they want you to do something, what's the first arrow they can pull out and shoot you with? It's a DOR. And if that doesn't work, what's the next one? It's LUA. And if that doesn't work, they can do a C and D. They have all kinds of already powerful administrative tools. They don't need this extra thing carved in this regulation. And then it's very interesting. This sets further restrictions on the ability of a credit union to pay dividends. Last time I checked, boards of directors of the credit unions actually make those decisions on well, of course, Brad, I know you actually tell them what you would suggest, and they say, yeah, absolutely, that's a good idea. Mostly, that's how it typically works, right? But the board sets those dividend rates, okay? Now, your examiner can come in and say, oh, you have to cut your dividend rate, and you can't appeal it. You just have to take that. Wow, that one's a little rough. Our concerns is we don't think NCUA has justified the need for this rule adequately. They would assume additional authority to impose even higher capital requirements on individual credit unions. I've said that on the previous slide. Also, the NCUA would require that your 1% deposit be ignored in the risk-based capital workshop. Well, that's a fairly significant amount of money that we have and how is that a risk asset? NCUA actually has the money, okay? And to ignore that, well, that's a significant piece of your balance sheet that they're ignoring. Also, more credit unions than the NCUA has indicated would be impacted as their net worth would fall to just barely over well capitalized. Like I said, they've done the calculation. There's about 200 credit unions that are going to be impacted significantly by this rule. So the NCUA's position is, well, gosh, it's only 200 credit unions out of, whatever, 8,000. That's actually, that's not a very small number. That's a decent size number. But the problem is the next 300 or 400 credit unions that are kind of on that bubble of tipping into that area. That's the real problem. Also, we would like to see more time to phase this rule in. And then the risk weightings are just completely crazy. You got business loans and mortgage concentrations, QSO investments. They do not appear to be properly calibrated for credit unions. Using higher risk weights on long-term assets to deal with interest rate risk is misleading without considering when they mature. So some elements that are being deducted from the sum of the risk-based capital elements, they include the inclusive capitalization deposit, also your goodwill if you're involved in a merger, and other intangible assets. So our efforts are going to be focused on several different areas. Number one, we would like to see them take the risk-based capital and peg it to adequately capitalized instead of well capitalized. We think that would step it down just a little bit. We think they've underestimated the economic impact of the rule. We also want the NCUA to make improvements, eliminating the provision for the case-by-case requirements, changing the rating, the various risk weightings, and then extending the transition period significantly. This much is clear. This is a regulation in search of a problem. And on this next slide, I'm going to demonstrate that. This I borrowed from Bill Hampel, CUNA's chief economist. It's a really good slide. And this shows, going back to 1988, what the NCUA insurance fund has been. 124, 125. During the 91 recession, when the bank fund went into the negative, ours dipped all the way to 123. And then the bank fund came back after that recession, and we've stayed really close here. And then Great Recession, 07, 08, 09, whew, bank fund went negative. We again dipped all the way to 1.23. So if you look at this chart and you say, well, gosh, credit unions have been a really problem, I'm like going, really? Who's buying that argument? Because we've in the last 3 years they've kept it at 1.30, and it's kind of interesting. The NCUA is required by law to keep the insurance fund between 1.2 and 1.3. If it falls below 1.2, they charge you a premium. If it goes above 1.3, they normally, if we didn't have that corporate situation, they would actually write you a check. I mean, we've had that happen before. Now, one other point here. The bank fund is improving very quickly, and we're very, even though we're not here to talk about the banks, we're glad to see the bank fund get better and stronger. Because if it's not, what would happen is the people in Washington, they have a solution. They would sweep everybody together and put us all together, and we really don't want that to happen because our fund has been pretty darn strong, and it works differently than the bank fund. The banks pay an annual premium all the time for their insurance. We pay our 1% deposit and normally don't have to pay anything more. In fact, usually we get something back, or we will. So here's comparing small bank Basel and the NCUA risk-based capital proposal. And there's three big things that are problems here. First one is residential mortgage loans. Oh, by the way, there's other things on here. You know, you got the CUSO rule. That's kind of crazy. I don't even have that in here. But the residential mortgage, if you're a small bank, 50% regardless of your concentration. If you're up to 25% of your assets are in real residential mortgage loans, it's also 50%. But if you've tipped over to 26%, your risk weight now goes to 75. And if you go to 35+%, they want you to treat 100% of those additional monies as a risk in your risk weight calculation. This is obnoxious. Yeah, we could live with this. I don't even think they really need this. But you know what? We know that that's not going to happen. So, you know, but we certainly need to be, we don't want to be treated any more strictly than the commercial banks are, the small community banks. Then we go to business loans. And this is not a big issue for us because most of our credit unions haven't been doing business loans. I mean, Bradley, you can't do business, you're capped at 12.25% of your net worth under the current rules. So, you do some business loans, but you don't make it a major part of your block of business. But what they did with the small bank Basel, it's 100% regardless of concentration. With credit unions, the NCUA thinks that if you get above 25%, you need to have a factor of 200%, twice as much as what the small banks are being allowed. And here's one of the problems. Why did the NCUA do this? Why did the NCUA staff recommend that the NCUA do this? Well, they start looking at specific instances of where they've had problems. And one of those instances, the Inspector General, anytime there's a loss to the insurance fund of more than $10 million, they're required to do what's called a material loss review. And they did a material loss review of Telesis. And, Telesis was a credit union that was involved heavily in business lending, and they were involved in one particular sector of business lending in one particular part of California. And when the Great Recession happened, that part of California suffered greatly, and that sector suffered. And as a consequence, all natural person credit unions got to write it. Well, it cost the insurance fund. It cost us. It cost y'all quite a bit of money. So the NCUA has said, well, we don't like that, so we want to make that a higher risk weight. Well, you know what? If they have a problem, grab their door arrow. Grab their LUA arrow if you ignore the door arrow. They have a lot of administrative tools that they can use. They don't need to put these artificial constraints on business lending that, because if you do very good business lending, it can be a great service to the economy, to your community, and it can be very good for your members as well. Finally, well, like I said, the three big things that bother me the most are, as I said, the mortgage and the small businesses, but then the implementation deadline. This is ridiculous. Small banks, 9 years. Oh, credit unions, you only get 18 months. I wonder what the NCUA people were thinking on when they wrote that, because 18 months, wow. Let's say you decide you want to restructure your balance sheet. You want to fix it. Jennifer, you have too much in real estate and you want to make it be a little bit less dependent on real estate. How can you fix that in 18 months? Probably not unless you do some fire sales and get rid of some assets, and that's going to cost you money. Over 9 years, yeah, you're in a little bit better shape. A little bit better shape. Now, I get up on my soapbox here. This is one of my favorite places to get to. And let's talk about the corporate bailout. They have been, in my opinion, overly zealously taking money from our credit unions. For several years, I've advocated that the NCUA lower its assessment as it was taking too much from credit union earnings and capital. How ironic is it that they now want you to increase your capital? They've been taking it away. Now they want you to build it back up, and they don't give you much. But it's interesting, if you look at what the range of the estimated losses are from the corporate assessments, or from the corporate bailout, both ends of the range are in negative territory. What that means, if it stays in negative territory, in 2021, when the program expires, the NCUA will have to write you all a check. Currently, the range is negative $2 billion to negative $600 million. So if it stays that way, it's going to be a check back to the credit unions. And I'll get into that in a few seconds. This is a chart showing what things looked like in 2010, the first estimate. They used a company called PIMCO to calculate what the losses were on these underlying mortgages that supported the assets that were at the various 5 corporates that were conserved. Then they changed to BlackRock, and you can see that it's been narrowing. And you can see that the trend line seems to be going down pretty significantly. It's interesting that if you take a look at that, from July of 2010 to the end of 2013, 3.5 years later, the estimates of losses have dropped by almost 40%. Now, Jennifer, I got a question for you. 3.5 years ago, if you made an estimate that was off by 40%, is your CEO real thrilled with your predictive powers? He would understand, yes. Yes, he would understand, but would he would not be real excited about that. Mary, how about, no, not excited at all. No, I didn't think so. So that's that's a fairly significant miss. That's, I mean, 40%, 15%, 10%, okay, I can buy those. Now, it's very interesting. Why is that happening? And actually, Julie Renderos, the EVP, SVP, CFO, whatever, she's got more titles than you can imagine. Very smart lady. She's at Suncoast Credit Union. She said that they estimated what their losses would be on their mortgage portfolio, and it turns out it's half of what their losses would have been, what they predicted. When very intelligent people predict something and it's only half of that, it makes you wonder, why is that happening? Well, I think there's 2 factors that have happened. First off, the real estate market has improved steadily and continues to show signs of sustainable growth, due in large part to the Fed's policy of low interest rates, okay? We may not like the low interest rates because it kind of messes up our investment portfolio, but it certainly helped the real estate market, and you can ask anybody in there, and they like it. The second thing is, even though many mortgages were underwater, the vast majority of these homeowners have continued to make their monthly payments. Oh yeah, we've had some people that have bailed out on us, sure. But I know this, in the last 2 years, I've refinanced my 3 homes, and unfortunately, 2 of them were upside down. But I'm still making my payments because I like my homes. And, and I got 2 of them now in the black, barely. And one of them is, we're working on that other one. It's going to happen. I'm confident it's going to happen. My wife keeps saying, why don't we sell that house? And I go, well, gosh, honey, if we do, we recognize about $100,000 worth of write-off, which is real money to me. I would rather limp along for 5 more years and let real estate continue to recover. Anyway, so you've got these 2 factors that are happening. That's why we only see not as large of losses as we, because if everybody who was underwater bailed out, yeah, we would have had some pretty big hits, but we haven't seen that. With both ranges now in negative territory, if they stay negative, that when the corporate bailout program is completed in 2021, the NCUA will be required to refund money to credit unions. If the NCUA takes the 9-year approach that small bank Basel uses, let's see, 9 plus 2014, that makes it 2023. 2 years before we would be required to have any kind of Basel III requirements, if they did this, we would get a check from the NCUA that would serve to improve your net worth for everybody in the United States. Wow. Problem could be solved right there if they just slow down their crazy process here. So and I mentioned this earlier, if you want to see a link, or if you want to see the entire proposal, and I recommend you do. I haven't talked a bit about the QSOs, but that's a monster. And I know that, Envision, you guys have a fairly significant QSO. Everybody who has a QSO, you guys need to take a look at that and comment on that specific rule. This is a link. Now, what I'm going to do, I will email this entire presentation out to everybody who has come to one of these workshops. They're going to be getting that on Monday, maybe today if I get rolling, but I can't promise for today. But it will give you all these slides and all this information. One last thought on the corporate assessments before I move off of that. The NCUA has had tremendous success in suing large banks that sold crappy mortgage-backed securities to the corporates. Better than I ever would have expected. Better than I think anybody ever would have expected. Who thought that they would beat J.P. Morgan out of a lot of money? I didn't think so. So they've actually, they've done pretty darn good on that. Of course, they did get some very excellent lawyers to do that. And with several suits still in progress, it seems likely that they will achieve additional successes, which will translate into additional positive results for natural person credit unions. So finally, loan growth has arrived at credit unions. People are borrowing again. And I know why this happens. A couple years ago, in 2008 and 2009, I got my 401k statement. I would open it and then I would put it over here and try not to look at it. Okay? I did look at it once. I went, oh my God, what's happened to that thing? But now, when I get my CUNA Mutual 401k statement, I'm like going, oh, sweet. Let me put that in the computer. Oh my God, it's up 20%. Excellent. Very happy with 401k. And when your 401ks look better, you feel richer. And when you feel richer, you go out and buy cars. Which is why we have some new cars in my family. Of course, the kids all needed new cars too, so we kept rolling them downhill. But we're doing that. Lots of people are doing that. Cars are back. Loans are coming back. So the biggest thing, the shorter deadline to comply with Basel III would not give credit unions sufficient lead time to plan for the new requirements. This is particularly important as credit unions may wish to alter their balance sheet. A couple other just kind of interesting points. You can use these in your letters. And one of the things, when I was down in West Palm Beach yesterday morning, Rob Delaney suggested, and Jared, I think this is a great idea that Rob had. He said, Bill, we want to get our directors to do letters. We want our directors to send letters. This is a very complex proposal. Could you create cliff notes for directors? And I said, absolutely. I mean, that's a great idea, Rob. And so, we're going to put out kind of a cliff notes for your directors and maybe even a sample letter with just 2 or 3 of the things that we were really upset about. And maybe you can get your directors, and we'll send it to you in Word, so it's going to be very easy for you to, fix it the way you want to fix it. But I thought that was an interesting idea. Banks can raise capital by issuing stock. How do we raise capital? We retain $1 at a time. Unlike the Basel system, which assigns weights exclusively on the basis of credit risk, NCUA's risk weights would cover credit risk, of course, but interest rate, concentration risks, and other risks. This is our typical regulatory overkill. So during the comment period, we encourage credit unions to copy your lawmakers on your comment letters. Additional information are available at lscu.coop. One very efficient way to submit a comment letter is to go to cuna.org and log on. And I have some areas where you can go do write the comment letter right there on their website. It's very easy. It copies your representatives. It's very very nice. There's 4 different ways to actually submit a letter. You can send it by mail. You can send it by electronic means. You can send an email, which I guess that's sort of electronic. And then, does anybody still fax stuff? Anybody? I hate faxing. If you can't email it to me, I don't want to get it. But anyway, you can still send faxes. One of the things that's very interesting, and we talked about this earlier, or Patrick was talking about it, the NCUA is going to have some listening sessions. There's going to be one in Los Angeles, one in Chicago, and one in Alexandria. Jared, I think you're going to the one in Alexandria probably, and Patrick's going to the one in Chicago more than likely. These are likely to be contentious, ugly sessions. We also advocated strongly that they hold one of these listening sessions down here in Florida or Alabama, and we got no traction with that, unfortunately. But these have the potential to be very difficult. Now, About a week ago, Heather Anderson, and you said that, let's see, who was it, was at this meeting? Chuck Adcock, thank you. Chuck was at this meeting. Well, I actually read this article and I thought, this is pretty cool. And I like what Heather Anderson writes. She does a really good job. And what she says in her article, if the NCUA's luncheon session at the CUSO conference last week was any indication, Chair Matz and her crew will face hostile crowds during this summer's listening sessions. The CUSO audience's response to the usually winsome Rick Metzger wasn't the worst reception I've seen, but it was a far cry from his debut on the stage at the GAC when he had them eating out of the palm of his hand. In Orlando, nobody laughed at his jokes, nobody even cracked a smile. Wow, that's pretty awful. And most importantly, nobody bought what he was selling because he said the risk-based capital rule only affects 200 credit units. You know, we've done the calculation. It's only 200 credit units. It's only 200 credit. Well, yeah, but there's 400 more that are really close. and it's going to trip them. We will go into a recession. Not maybe this year, hopefully, maybe not next year, hopefully. But, you know, every time, you know, well, it's always going to be good. But no, it's never good. We have recoveries, we have recessions. You know, I mean, we've all been around. We know how the economy works. And I'm sure, as Metzger claims, some credit unions will find they have more capital. That's true. I know it, than under the current net worth measure. But I'd venture to guess those credit unions aren't among the industry's top performers and probably shouldn't be held up as an example of balance sheet management done right. Heather Anderson goes on, one audience member nailed the underlying problem with the risk-based capital proposal. Risk brings reward in the form of higher returns, which are the only way credit unions can build capital. This proposed rule so severely limits those risks, it may have the unintended consequence of reducing the industry's capital cushion, not increasing it. That's like an unanticipated byproduct of their proposal. It could make us weaker, not stronger. And then he goes on, I hope you thought about that as you wrote the rule, the executive told the panel. The NCUA executives, nothing. Radio silence. Wow. They were not prepared. Second audience member said, we move money for a living. Everybody here knows this. I mean, this is our job. We move money for a living. It's inherently risky. You can't regulate the risk out of that. Those comments are not earth-shattering, but Heather Anderson was stunned that the panel didn't prepare better responses. I sure hope Matz has something better than the deer in the headlights expression displayed by the NCUA staffers, or things could get ugly this summer. Wow. I don't think credit unions are upset they'll be subjected to risk-based capital. It's coming. You're going to be subject to something like this. I mean, you cannot get away from it. However, it's far more conservative than what Basel requires of bankers. Additionally, NCUA tries to address other balance sheet risks with this rule, the interest rate, concentration. They really messed it up. So there's a draft letter out there on the CUNA website. You could use whatever information you like here. You can use previously established language. The key takeaway here is make your voice heard. If you don't, it's so much easier for us to fix this regulation right now, because if it comes in and it handcuffs everybody, for the next 15 years we're going to fight the NCUA on this day and night to try and make this better. It's much easier to get this thing fixed on the front end. Also, I mentioned this before, copy your congressman or your congresswoman and your two senators, and tell the NCUA that you are doing so. And this will encourage them to weigh the disparate treatment. By the way, that's kind of like a Reg B thing, disparate treatment. We want to use that one. I like that. That the NCUA is proposing to do to credit unions when compared to small banks under Basel III. It will be very difficult for NCUA board to ignore a letter signed by a couple of hundred members of Congress. Here are the materials from CUNA's website. The subject line, I'm writing on behalf of your credit union. Like I say, you guys can read this yourselves. You should answer these questions. Is it necessary? How would your credit union be affected? Should they be able to impose higher capital requirements? Do you agree with the risk weightings? Should the inclusive deposit be excluded? Should goodwill be excluded? Should the NCUA be able to restrict your dividend payments? Do you agree with the NCUA's implementation timeline? Other concerns, a summary. Thank you for the opportunity to comment on this, blah, blah, blah. Sign it. Copy your representatives. Copy CUNA. Copy the LSCU. We think this is this proposal has the potential to have one of the most significant impacts on credit unions that I've seen in my 25 years here. We need to fight this thing tooth and nail. So that's what I wanted to share with you all this morning.